Question 1. Policy provisions and causes. What is the primary purpose of the incontestability clause in a term life insurance policy? A. To allow the insurer to adjust the premium based on the insured's health status. B. To ensure that the policy remains in force during the grace period. C. To prevent the insurer from contesting the validity of the policy after a specified period. D. To allow the insured to change beneficiaries at any time without restrictions. Answer. C. Explanation. The incontestability clause is a critical provision in life insurance policies that typically becomes effective after a specified period, often 2 years from the policy's issue date. Its primary purpose is to protect policyholders from having their claims denied due to misstatements or omissions made during the application process. And after the specified period, the insurer cannot contest the policy's validity based on such misstatements, ensuring that beneficiaries receive the death benefit as intended. This clause promotes consumer confidence and stability in the insurance market as outlined in the Nebraska Department of Insurance regulations. Question 2. Underwriting and risk assessment. Which of the following factors is least likely to be considered when underwriting a term life insurance policy? A. The applicant's occupation and lifestyle. B. The applicant's medical history. C. The applicant's credit score. D. The applicant's age and gender. Answer. C. Explanation. While underwriting involves a comprehensive assessment of various factors to classify risk and determine appropriate premiums, the applicant's credit score is generally not a primary consideration in life insurance underwriting. Instead, underwriters focus on factors such as the applicant's occupation, lifestyle, medical history, age, and gender. These elements directly impact mortality risk and the likelihood of claims, guiding the insurer's decision-making process. Federal laws and NAIC model regulations emphasize fair underwriting practices, but credit scoring is more relevant in property and casualty insurance. Question 3. Scenario-based question. Mr. Thompson has recently purchased a renewable term life insurance policy that will expire in 10 years. He is currently healthy, but he has concerns about potential future health issues that may arise. What should Mr. Thompson consider regarding the renewal option of his policy? A. He should immediately convert the policy to a whole life insurance policy to lock in current rates. B. He should review the terms of renewal carefully, as premiums may increase significantly at renewal due to his age. C. He should cancel the policy now, as he will not be able to afford the premiums in 10 years. D. He should choose to make no changes, as the insurer cannot raise premiums based on future health conditions. Answer. B. Explanation. Mr. Thompson should be aware that while his renewable term life insurance policy allows him to extend coverage beyond the initial term, premiums will typically increase at renewal based on his current age and prevailing mortality rates. Insurers assess the risk associated with older applicants, which may result in higher premiums compared to his original rates. It's crucial for him to review the policy's renewal terms to understand how his premiums will be affected and to evaluate his options regarding conversion to a permanent policy if he anticipates health issues in the future. This knowledge aligns with the principles of risk management and consumer protection laws, as emphasized by the Nebraska Department of Insurance. Question 4. Premium calculation and payment options. Which factor is most likely to lead to a decrease in the premium amount for a term life insurance policy? A. Increasing the death benefit amount. B. Choosing a shorter policy term. C. The insured's health deteriorating. D. The insured opting for a higher risk occupation. Answer. B. Explanation. Choosing a shorter policy term typically results in lower premiums because the insurer's exposure to risk is reduced. Shorter terms mean the likelihood of a claim being made is lower over that duration, especially if the insured is younger. In contrast, increasing the death benefit amount, option A, would raise premiums, while deteriorating health, option C, and higher risk occupations, option D, would also lead to higher premiums due to increased risk to the insurer. Question 5. Claims process. What is the first step a beneficiary must take when filing a claim for a death benefit under a term life insurance policy? A. Submit a claim form with supporting documents. B. Notify the insurance agent about the insured's death. C. Wait for the insurer to contact them regarding the claim. D. Cancel the policy to avoid future premiums. Answer A. Explanation. The first step for a beneficiary is to submit a claim form along with required supporting documents such as the death certificate and proof of identity. This initiation of the claims process is critical for ensuring that the insurer has the necessary information to begin evaluating the claim. While notifying the insurance agent Option B is a good practice. It is not the formal first step. Waiting for the insurer. Option C can delay the process and cancel in the policy. Option D is irrelevant once a claim is being filed. Question 6. Tax implications. Under current federal tax laws, which of the following statements about term life insurance death benefits is true? A. Death benefits are subject to income tax for the beneficiary. B. Death benefits are subject to estate tax if the policy is owned by the insured. C. Death benefits are exempt from both income and estate tax. D. Death benefits become taxable if the policy has been in force for more than 10 years. Answer. C. Explanation. Under current federal tax laws, death benefits from a life insurance policy, including term life insurance, are generally exempt from income tax for the beneficiary. Option C. However, they may be subject to estate taxes if the deceased estate exceeds the federal estate tax exemption limit, especially if the insured owned the policy. Options and D are incorrect because death benefits are not subject to income tax regardless of the duration the policy is in force, and option B can be misleading without considering the overall estate value. Question 7. Practical applications and case studies. The client, Mrs. Rivera, is evaluating different term life insurance policies. She is considering a level term policy versus a decreasing term policy. Which of the following scenarios best illustrates the advantages of a level term policy for her financial planning? A. Mrs. Rivera plans to cover a growing mortgage balance that decreases over time. B. Mrs. Rivera wants to ensure her beneficiaries receive a consistent death benefit regardless of when she passes. C. Mrs. Rivera expects to have low premiums as she ages. D. Mrs. Rivera is preparing for retirement and requires a policy that offers premium flexibility. Answer. B. Explanation. A level term policy offers a fixed death benefit for the entire term, providing certainty and financial security to Mrs. Rivera's beneficiaries. Option B. This feature is particularly advantageous for individuals who want to ensure that their loved ones will receive a consistent amount, regardless of when death occurs during the policy term. In contrast, a decreasing term policy, option A, is typically used to cover debts like mortgages that diminish over time. Options C and D do not accurately represent the characteristics of level term policies, as premiums usually increase with age, and while flexibility may exist, it is not a defining feature of level term policies. Question 8. Regulatory framework. Which of the following is a key requirement set by the Nebraska Department of Insurance regarding advertising for term life insurance? A. All advertisements must include a complete policy disclosure. B. Advertisements must clearly state that the insurance product is a term life policy. C. Advertisements can only use testimonials from licensed agents. D. All promotional materials must include the insurer's financial rating. Answer. B. Explanation. Nebraska law requires that advertisements for life insurance products clearly identify the type of policy being advertised, including whether it is a term life insurance policy. Option B. This requirement helps consumers understand the specific product they are considering, while complete policy disclosures, option A, are important. They are not necessarily mandated for all forms of advertising. Testimonial regulations, option C, and financial rating disclosures, option D, are not universally required in advertising, although they may be good practices. Question 9. Underwriting and risk assessment. When considering underwriting guidelines, which of the following statements is true regarding lifestyle factors affecting premium rates? A. Smoking status has no impact on premium calculations. B. Individuals with high-risk hobbies are likely to pay lower premiums. C. Policyholders with a history of substance abuse may face higher premiums. D. All lifestyle factors are irrelevant as long as medical conditions are disclosed. Answer. C. Explanation. Underwriting guidelines typically consider lifestyle factors significantly, including smoking status and engagement in high-risk activities. Individuals with a history of substance abuse, option C, are likely to face higher premiums due to the increased risk they pose to insurers. In contrast, smoking status, option A, is a well-known factor that generally increases premiums. High-risk hobbies, option B, usually lead to higher rates, and option D is incorrect as lifestyle disclosures are critical in the underwriting process to accurately assess risk. Question 10. Claims process. Which statement best describes the impact of the grace period on a term life insurance policy? A. The policyholder can extend the policy duration without payment during the grace period. B. The policy remains in force even if premiums are not paid during the grace period. C. The insured can claim benefits even if the policy lapses during the grace period. D. The insurer is obligated to pay claims regardless of policy status during the grace period. Answer B. Explanation. The grace period is a provision that allows the policyholder additional time, typically 30 days, to pay overdue premiums without losing coverage. Option B. If the premium is paid within this period, the policy remains in force. If the premium is not paid, the policy may lapse, but any claims that occur during this period will be evaluated based on whether the premium was ultimately paid. Options A, C, and D misrepresent the grace period's purpose, as the insurer is not obligated to pay claims for lapsed policies. Option D, nor does it extend the policy duration. Option A. Question 11. Key terminology. Which of the following terms refers to the individual who has the right to make changes to a life insurance policy? A. Beneficiary. B. Policyholder. C. Underwriter. D. Answer B. Explanation. The policyholder, option B, is the individual who owns the life insurance policy and has the authority to make changes such as adjusting coverage, changing beneficiaries, or cancelling the policy. The beneficiary, option A, is the person entitled to receive the death benefit, while the underwriter, option C, assesses the risk associated with the policy, and the insured, option D, is the individual whose life is covered by the policy. Understanding these roles is essential for navigating the policy's management and rights. Question 12. Underwriting and risk assessment. When evaluating an applicant's risk for a term life insurance policy, which of the following factors is least likely to influence the underwriting decision? A. Family medical history. B. Credit score. C. Occupation. D. Age. Answer B. Explanation. In the underwriting process, factors such as family medical history, option A, occupation, option C, and age, option D, are crucial as they directly affect mortality risk. Family medical history can indicate hereditary health issues, occupation can affect exposure to risks, and age typically correlates with increased mortality risk. A credit score, option B, while important for other types of insurance like property, is generally not a direct factor in determining life insurance premiums. Question 13. Policy provisions and causes. Which cause in a term life insurance policy ensures that the insurer cannot deny a claim based on misrepresentation after the policy has been in force for a certain period? A. Grace period clause. B. Incontestability clause. C. Reinstatement clause. D. Misstatement of age clause. Answer B. Explanation. The incontestability clause, option B, protects policyholders by preventing insurers from contesting a claim based on misrepresentation after the policy has been in force for a specified period, typically 2 years. This provision encourages accurate and truthful applications while also providing security for policyholders against unexpected claim denials. The grace period, option A, relates to premium payments. The reinstatement clause, option C, allows for restoring lapsed policies, and the misstatement of age clause, option D, adjusts benefits based on the correct age. Question 14. Claims process. If a claim is denied due to the insured's misrepresentation of health status, what recourse does the beneficiary have under Nebraska law? A. No recourse, so the claim is void. B. The beneficiary can appeal the decision to the Nebraska Department of Insurance. C. The beneficiary can sue the insurer for bad faith. D. The beneficiary can request a review of the claim by a third-party arbitrator. Answer B. Explanation. Under Nebraska law, if a claim is denied based on misrepresentation, the beneficiary may appeal the insurer's decision to the Nebraska Department of Insurance. Option B. This department regulates insurance practices and can investigate complaints, while suing for bad faith. Option C is possible in some cases. It typically requires evidence of wrongful denial practices. Requesting a review by a third-party arbitrator. Option D may not be a standard procedure for insurance claims, and option A is incorrect as beneficiaries have avenues for recourse. Question 15. Regulatory framework. Which of the following is a key responsibility of the Nebraska Department of Insurance regarding life insurance policies? A. Approving or advertising materials for insurance products. B. Ensuring that insurers maintain adequate reserves to pay claims. C. Mandating the types of life insurance policies that can be sold. D. Providing life insurance products directly to consumers. Answer B. Explanation. The Nebraska Department of Insurance, option B, is responsible for regulating the insurance industry, including ensuring that insurance companies maintain adequate reserves to fulfill their obligations to policyholders. This is a crucial aspect of regulatory oversight to protect consumers. While they oversee advertising, option A, for truthfulness, they do not approve all materials. They do not mandate specific policy types, option C, and do not sell products directly to consumers, option D. Question 16. Tax implications. Which statement accurately describes the tax treatment of term life insurance policy loans? A. Policy loans are considered taxable income to the policyholder. B. Policy loans are exempt from taxation as long as the policy remains in force. C. Policy loans can only be taken against whole life policies, not term policies. D. Policy loans incur a gift tax if the amount exceeds the death benefit. Answer B. An explanation. Policy loans taken against the life insurance policy, including term policies, are generally exempt from taxation as long as the policy remains in force. Option B. If the policy lapses, the loan amount may become taxable. Option A is incorrect because loans are not treated as taxable income. Option C is also incorrect since policy loans can be accessed in some permanent policies, but term policies typically do not offer this feature. Option D misrepresents how tax laws apply to loans. Question 17. Problem solving and critical thinking skills. Mr. Thompson, a 45-year-old healthy individual, wants to provide financial protection for his family in the event of his untimely death. He has two options: a 20-year level term policy and a 30-year decreasing term policy. Which option would best serve his needs if he prioritizes a fixed death benefit? A. 20-year level term policy. B. 30-year decreasing term policy. C. Both options are equally viable. D. Neither option provides a guaranteed death benefit. Answer A. Explanation. A 20-year level term policy, option A, would best serve Mr. Thompson's needs if he prioritizes a fixed death benefit. This type of policy maintains the same death benefit throughout the term, ensuring that his family receives the same amount regardless of when he passes within that period. The 30-year decreasing term policy, option B, would not meet his needs as it provides a decreasing death benefit over time, which may not adequately support his family's financial needs. Option C is incorrect because the benefits differ, and option D is false since both policies provide a guaranteed death benefit, but only the level term does so consistently. Question 18. Current trends and issues in term life insurance. How have recent technological advancements impacted the underwriting process in term life insurance? A. They have eliminated the need for any medical examinations. B. They have increased the reliance on traditional underwriting methods. C. They allow for faster risk assessments and improved accuracy in underwriting decisions. D. They have made it more difficult for insurers to evaluate risk factors. Answer C. Explanation. Recent technological advancements, option C, have significantly improved the underwriting process by allowing for faster risk assessments and enhancing accuracy. Insurers can now utilize data analytics, electronic health records, and artificial intelligence to evaluate risk more effectively, while some simplified issue policies may not require medical examinations. Option A. Traditional underwriting methods are still relevant, option B, and have been complemented by technology rather than replaced. Therefore, option D is incorrect as technology has generally improved risk evaluation, not hindered it. Question 19. Premium calculation and payment options. Which of the following scenarios would most likely result in a higher premium for a term life insurance policy? A. A 30-year-old non-smoker with no health issues. B. A 45-year-old smoker with a family history of heart disease. C. The 50-year-old female with a healthy lifestyle. D. A 35-year-old male who exercises regularly but has a prior history of cancer. Answer B. Explanation. A 45-year-old smoker with a family history of heart disease, option B, would most likely face a higher premium due to increased risk factors associated with both smoking and family medical history, which raises the likelihood of claims. Option A represents a low-risk applicant, while option C indicates a healthy individual, likely resulting in standard premiums. Option D may still face higher premiums due to the history of cancer, but the age and smoking status of option B represent more significant risk factors overall. Question 20. Claims process. What is the primary purpose of the claim investigation process after death occurs under term life insurance policy? A. To verify the beneficiary's identity. B. To determine the cause of death and the validity of the claim. C. To assess the insured's financial status prior to death. D. To evaluate the adequacy of the policy coverage. Answer B. Explanation. The primary purpose of the claim investigation process, option B, is to determine the cause of death and verify the validity of the claim. This ensures that the claim meets the terms of the policy, particularly regarding exclusions or limitations. Verifying the beneficiary's identity, option A, is part of the process but not its primary goal. Assessing the insured's financial status, option C, is typically not relevant to the claim process, and evaluating the adequacy of coverage, option D, is not a focus after the insured's death has occurred. Question 21. Policy ownership. Which of the following statements is true regarding the ownership of a term life insurance policy? A. The insured must always be the policyholder. B. A parent can take out a policy on a child's life without their consent. C. The policyholder has the right to change beneficiaries without notifying the insured. D. Ownership cannot be transferred once the policy is issued. Answer C. Explanation. The policyholder, option C, has the right to change beneficiaries without the insured's consent, provided the policy does not specify otherwise. The insured does not have to be the policyholder, option A. Someone else can own the policy, while a parent can take out a policy on a child's life. Consent requirements may vary by state. Option B. Ownership can be transferred after the policy is issued, option D, allowing for flexibility in managing the policy. Question 22. Policy features. What is a primary feature of a convertible term life insurance policy? A. It offers a guaranteed renewable term. B. It can be converted to a whole life policy without additional medical underwriting. C. It provides decreasing coverage over time. D. It is only available for individuals over the age of 60. Answer B. Explanation. A convertible term life insurance policy, option B, allows the policyholder to convert the term policy into a whole life policy without needing additional medical underwriting, which can be beneficial as the insured ages or if health conditions change. The guaranteed renewable term, option A, refers to a different feature. Convertible policies do not necessarily provide decreasing coverage, option C, and there are no age restrictions like those in option D. Question 23. Exclusions. Which of the following scenarios would most likely be excluded from coverage under a standard term life insurance policy? A. Death due to a heart attack after 5 years of coverage. B. Death from an accident while skydiving. C. Death resulting from suicide within the first 2 years. D. Death due to natural causes at the age of 70. Answer C. Explanation. Death resulting from suicide within the first 2 years, option C, is typically excluded from coverage under most term life insurance policies, known as the suicide clause. Death from a heart attack, option A, or natural causes at age 70, option D, would generally be covered if the policy is in force. Although some policies may impose exclusions for high-risk activities like skydiving, option B, this would depend on the specific policy terms and underwriting considerations. Answer C. Explanation. A level term life insurance policy, option C, maintains a constant death benefit throughout the entire term, providing consistent coverage. In contrast, a decreasing term policy reduces the death benefit over time, option A. Some policies might have increasing premiums, option B, but this does not define a level term policy. Additionally, policyholders typically cannot access the death benefit while alive, option D. Question 24. Benefit design. Which of the following best describes a level term life insurance policy? A. The death benefit decreases over the term of the policy. B. The premiums increase every 5 years. C. The death benefit remains constant throughout the policy term. D. The policyholder can access the death benefit during their lifetime. Question 25. Insurer responsibilities. What is one of the primary responsibilities of an insurer in relation to a term life insurance policy? A. To invest the premiums in high-risk securities for greater returns. B. To provide a clear and concise policy document outlining terms and conditions. C. To automatically adjust the death benefit based on the insured's income. D. To inform the policyholder of changes in the market rate for life insurance. Answer B. Explanation. One of the primary responsibilities of an insurer, option B, is to provide a clear and concise policy document that outlines the terms, conditions, and exclusions of the policy. This ensures the policyholder understands their coverage. Insurers are not required to invest premiums in high-risk securities, option A, automatically adjust death benefits based on income, option C, or keep policyholders informed about market rates, option D. Question 26. Premium calculation. Which factor is most likely to increase the premium for a term life insurance policy? A. The policyholder being a non-smoker. B. The policyholder's age at the time of application. C. The insured being in excellent health. D. The term length being set at 10 years. Answer B. Explanation. The age of the policyholder, option B, at the time of application is a significant factor affecting premium costs, with older applicants generally facing higher premiums due to increased mortality risk. A non-smoker, option A, and a healthy insured, option C, would typically qualify for low premiums. The term length of 10 years, option D, is relatively short and may not significantly affect the premium compared to age and health. Question 27. Market trends. What recent trend has influenced the term life insurance market in the last decade? A. Decreasing consumer demand for term life insurance. B. An increase in the use of technology for policy management. C. A rise in the number of companies offering only whole life policies. D. A significant reduction in the average policy term length. Answer B. Explanation. The last decade has seen an increase in the use of technology for policy management, option B, including online applications, digital underwriting, and customer service automation. While there may be fluctuations in demand, option A, it generally remains steady. The market has not significantly shifted to exclusively whole life policies, option C, and average policy term lengths have not drastically reduced, option D. Question 28. Financial planning. In what situation might an individual choose a term life insurance policy over a whole life policy? A. When seeking permanent coverage and investment growth. B. When needing affordable coverage for a specific period, such as raising children. C. When having a low income and not prioritizing life insurance. D. When wanting to accumulate cash value over time. Answer B. Explanation. Individuals often choose term life insurance, option B, when they need affordable coverage for a specific period, such as while raising children or paying off a mortgage. Whole life policies, option A, are intended for permanent coverage and cash value accumulation, which does not apply to term life. Low-income individuals, option C, may still prioritize some level of coverage, and cash value accumulation, option D, is not a feature of term policies. Question 29. Claims payment options. Which of the following is a common settlement option for beneficiaries of a term life insurance policy? A. Cash surrender value. B. An immediate lump sum payment. C. Increased premiums for ongoing coverage. D. Accumulation of interest within the policy. Answer B. Explanation. A common settlement option for beneficiaries, option B, is an immediate lump sum payment providing beneficiaries with the full death benefit at once. Cash surrender value, option A, applies to permanent policies, not term. Increased premiums, option C, are not a feature of claim settlement, and accumulation of interest, option D, occurs in cash value policies, not term life insurance. Question 30. Ethical considerations. Which of the following practices would be considered unethical in the life insurance industry? A. Providing accurate information on policy features to clients. B. Overstating the benefits of a policy to make a sale. C. Offering personalized policy recommendations based on individual needs. D. Disclosing all relevant exclusions in the policy document. Answer B. Explanation. Overstating the benefits of a policy to make a sale, option B, is considered unethical and can lead to misrepresentation and loss of trust. Providing accurate information, option A. Offering personalized recommendations, option C, and disclosing exclusions, option D, are all ethical practices aimed at promoting transparency and serving clients' best interests.